Oh man, we just received the September non-farm payrolls and we need to talk about this. So the results have just come in and I want to analyze those results with you and see what impact that's having on the stock market, the bond market, and whether this means Jerome Powell can finally announce his taper in the next meeting on the 2nd and 3rd of November. So let's start with the reading. So the market was expecting 500,000 new payrolls to come in September. Now, what actually happened was we received, drumroll, 195,000 new jobs. That is a big disappointment to the downside, guys. And let's just recap. We said, Jerome Powell said, if we get a moderate jobs report, that would all but signal a taper. He just waited. He said specifically when he was asked in the Q&A, does it need to be a strong one? He said it doesn't need to be a strong jobs report, just needs to be a moderate one. But when you miss more than 300,000 to the downside, so 194,000 jobs are created, and I'm going to show you this on a visual representation. So let's just put this into context, guys. So we can see here, 194,000 was the reading we just received for September. Now, in the previous month, we gained 366,000. The month before that, 1.1 million. Month before that, nearly a million. Month before that, 614K. So in order to get as low as that, even this month was not as low. You can see if it comes up, 233 in Jan. December 2020 minus 306. So this is the worst reading since December 2020. But obviously, it's still showing growth in jobs. Now, we need to understand that the headline figure of 194, this was actually made up of a fall of 123 in government-related jobs, but an increase of 317,000 in private jobs. So it was the government jobs loss of 123, which really weighed in on this jobs report. If government remained flat, we would have been up 317 new jobs in the private sector, right? So that reading is an astonishingly low reading, and this could have an impact on Jerome Powell's decision, but more on that in a second. Now, the other key things we wanted to look at on top of just the jobs figure, because the jobs figure helps you understand how the economy is recovering, but the other figure we wanted to look at was the wages figures, because the wages help you understand if we're seeing inflation. And remember, one of the market's key worries right now, inflation. So everybody's going to be looking at this number. And month-on-month wages came in at 0.6% month on month. And that is quite high, guys. So 0.6 month on month. If you analyze that, that's 7.2% annual inflation, okay? So it's still to the high side, and year-on-year wages are 4.6%. And that's why you're probably seeing, I'll come onto the stocks in a minute and look at how the prices are doing, but you're seeing fears of inflation continue. And again, the nail in the coffin for that, the final answer to that will be when we get our September CPI reading on the 13th, which is next week, okay? So we'll be covering that on this channel too. So don't forget to subscribe so we can cover that together. So you've got the CPI reading on the 13th, and then Jerome Powell convenes with the FOMC November the 2nd and 3rd. And this is going to help us understand how the next 6 to 12 months are going to pan out from an investment point of view, and it should instruct our investing philosophy. Very important. Now, the other thing to note, if I share, is we want to look at the unemployment rate. And we can see the unemployment rate came in at a lower 4.8, which is progress. 5.1 was expected, so that's better. But it's still not quite the pre-pandemic levels, okay? So you can see unemployment was 3.5% pre-pandemic, and we're at 4.8%. So we're still slightly off. And it's got some investors wondering if we'll ever get to that level, because we're still quite far off that figure. So it's important that we look at that. Now, coming back on to the new jobs we saw, the jobs which were created came 74,000 new jobs in leisure and hospitality. We saw 60,000 in professional and business services, and retail picked up 56,000 new jobs. Now, it's important to remember that the survey for this reading was taken in the week September 12th, okay? And we know that cases were spiking back then due to Delta, so hopefully things would have progressed now. But again, we only get the data on a 1 month lag, and Jerome Powell will be using this reading to inform his decision. Now, the consensus is that Jerome Powell has always said we want to meet substantial further progress, right? That's the thing he keeps saying. And this reading, in my opinion, does not meet substantial further progress. This is an upset to the downside in terms of the number of jobs. And this, anything which was strong around target, even even a high 300, 450, 500 is expected. Anything around there, Jerome could have gotten away with starting tapering. Now, that doesn't mean we won't see tapering announced when he meets in November. We could still. But now there's a little bit of risk of, a bit of a taper tantrum, right? Because the market's going to be like, hang on a second, the economy's not recovering. We're in a fragile state. Why are you doing this? And Jerome Powell's made it very clear from the beginning, he wants to telegraph this. He wants the market to know when tapering's happening, and he doesn't want them to be surprised. So this reading's thrown a bit of a spanner in the works, because he was just hoping for an okay jobs report. And then nobody can cry, nobody can complain, tapering's coming, I've told you plenty of times, here we go. But now he's back at square one, because the data, and if inflation gives you an odd reading next week, then this is going to become very tricky for Jerome Powell, because if he lets the economy heat for too long, then inflation's going to be an issue. We can already see it as an issue, right? If he takes his foot off the gas too early, we can risk stagflation. And stagflation is where we're seeing inflation going up, but the economic growth, GDP and jobs, employment, is not improving in line. That is stagflation, and the market will start to be concerned about this. Right, so that's what we got. Now let's head back over and look at the markets. Let's see how the markets are reacting. So we can see that the S&P is flat, the Dow is flat, and the Nasdaq is flat. So what we're seeing is the market is a bit uncertain right now. The market doesn't know how to take this jobs report, really. I mean, if it went if it was a positive reading, then we would have known what to expect. We would have expected tapering, and therefore you would have seen a little bit of rotation outside of stocks. But as we're seeing this, the market seems okay. It's kind of just parring its gains. It's not been the roller coaster of this week has maybe worn everybody out, but we've had highs, we've had lows, and now the market's just kind of chilling and flat at the time of recording. Now, we've still got 4 hours until the market shuts. Anything can change. The other thing to note is the 10-year has spiked. Okay, so that's gone nice and high. Look at that there. If that refreshes. So that's spiked. You can look at that there. We've gone from there straight up, and we're sitting now at 1.614. Okay, so quite a bit up here on the 10-year Treasury note. So the yield curves are going up. And remember why this happens, guys. So this can give you a clue that the market is probably still expecting tapering. Okay, so the market seems to be pricing in tapering, because if tapering happens, that means the Fed are buying less bonds. Okay, if the Fed is buying less bonds, it's important to understand that bond prices fall and therefore yields go up, because yields move inversely to bond prices. Really important we understand that. That's why we've seen a tick up in the Treasury yields, and the stocks have been fairly flat today. Just looking at crypto, how has crypto done today? We've got Bitcoin sitting at 54,000, flat as well. So Bitcoin hasn't seen massive, the only reason Bitcoin would move is if we got a reading which suggested massive inflation. We didn't get that. We got a 0.6 month on month, which annualizes 7.2%, but we didn't see a ridiculous 1% month on month increase in wages. So Bitcoin is not massively excited about that one. So let's take a look at a few of the individual stocks. Let's start off with the top movers. So as we can see, Car is up, Affirm is up 4%. You've got Marathon, Bitcoin play. You've got Ford up 3%. Interesting. Blink up 2%. Deliveroo up 1%. All fairly low. Nothing's moving majorly apart from Avis at the top there. They must have had a catalyst. I'm not too sure. Affirm is going on another run as well, up to 140. And then everything else is pretty flat, but airing on the side of green at the time. And you can see from the spark lines, it's kind of been a mixed. Some are starting red and going into the green. Some have started green, dipping into the red, back into the green. It's been a mixed bag. And if we look at that overall, you saw the Nasdaq started off opening red, went green, came back red, went green, came back red. This is a confused market right now. And I think this is going to cause a bit of a problem for Jerome Powell, who has the unenviable job of either choosing to taper or not to taper, with the risk of a taper tantrum. So not fun to be Jerome Powell right now. Let's go to the bottom of this watch list, and we can see Workhorse is down 3%, Lemonade down 3%, Peloton, Lucid, Palantir. All your growth stocks, your SPACs, your high-risk stocks are all down here. Starting with Tesla, down 1%, SoFi down 1%. You've got Snowflake, SaaS Play is down 1%. Enphase, the solar player, is down. Monday.com SaaS company is down. Palantir is down. AI data analytics company Lucid is down. The EV play. Peloton is down. Lemonade, the high insurance AI play, is down. So you can see the trend here is people are rotating a little bit. Matterport is down as well. Snapchat down. Etsy down. We are seeing a rotation out of growth stocks, but a couple of percent. It's not massive, and we've not seen a massive flight away from equities. And I think this is what I was alluding to yesterday, which is overall, the market understands that equities, stocks, are still where yield is to be achieved. The returns are still there within stocks. So we're not seeing a mass flood away from stocks, because ultimately, where are people going to put their money? There's loads of money in this market. We saw by the dips, we couldn't sustain any dips. Every time there's a market dip, it got bought up. So we know pockets are full of cash, and it needs to be assigned into equities, because they're not getting their returns on the bonds, and they're not getting returns in anywhere else at this point. Everything is inflated, saturated, done, right? So the only left yields are in stocks, but they're fearful of growth stocks because of the fear of inflation and tapering. So that's what we're seeing right now. So you're seeing, the S&P and the major indices currently up because of the non-tech plays really doing pretty well at this point. That can change overnight. I still think I'm still a long-term believer in growth stocks. If I see massive dips in these companies, I'm still buying, because I believe that list of the red, those are the ones which will ultimately bounce back. And then when things settle down around tapering and the debt ceiling crisis is finally resolved and we get through December, and we all the kind of fears of the market around inflation start to subside, everybody's going to search for that yield again, and they're going to rotate across to the high growth stock. And I want to be positioned in with my portfolio ready, having built a basis, buying the dips when everybody else was scared, which is right now. Now is the time they're scared. Leading up to Jerome Powell and the CPI reading next week, first of all, I can see more fear coming into this market. So really confused market right now. You can see gold is flat. Oil is up 2%. Everything else is flat. The Russell is literally plus 0.04% up. It's flat. And Dow is plus 0.04%, and the S&P is plus 0.03%. I mean, look at that. That's as flat as you can get. But like I said, it's getting weighed up by different types of companies. Your more recovery plays, reopening trades are doing a lot better, like Avis, versus your growth stocks, which we were looking at the bottom, all getting kind of slapped up at the bottom there. So there you have it, guys. That was the job reading. We had a massive miss on the non-farm payrolls, which now puts a spanner in the works for Jerome Powell, who has the job of deciding if we're going to taper or not. Just when you thought everything was nice and clear and easy, that's the economy, right? That's stocks, that's equities, that's investing, and you've got to react to the hand you're dealt. There you go, guys. Hope you found this analysis and perspective useful. If you like this type of perspective, then please don't forget to hit the like button and consider subscribing. I would love to have you on this journey, and I will see you in the next one.